It's another week here at the Dukascopy TV Centre and time for another Hollenbeck Unleashed for you. This week, Dr. Frank Hollenbeck joins us to discuss the housing market in China and the potential housing crash. Dr. Frank, thank you very much for joining us again today. Now, before we look specifically at China's housing market, let's discuss the current state of the Chinese economy slightly. Now, we all know that the Asian markets have been particularly hit hard by the Eurozone crisis. This was further emphasised by first quarter growth rates of just 8.1%. Can you expand on this for us?
Well, it is true that when you read the press, you get total different point of views. The IMF still anticipates growth of 8% for China and expects a considerable rebound in 2013. All this reminds me when I worked at the State Department for the Undersecretary of State. He came up to me and he said, look, we have these phenomenal growth numbers coming out of Russia. And I kind of just looked at him and I said, well, first, you actually believe the numbers coming out of a communist regime. And second, does it really matter if you're producing cabbage that no one wants to consume? And to some degree, we're seeing that in China. For example, steel production in April hit an all-time high in China. And China makes up about 50% of the world's steel production. It's also one of the largest consumers of steel. 60% of its domestic production goes into the construction industry. Now, a communist government can always force output. There was a recent study done by the China Iron Ore and Steel Association, which monitors about 80 steel mills. And those 80 steel mills produce steel at a considerable loss. And these steel mills cited basically low prices and a lack of demand for steel. So even though we're seeing production out of China, the question is it production where there's demand? And we're seeing goods and services pile up in ports in China. We're seeing steel production pile up. And in the case of steel production, we would expect it because you usually have the large construction booms we have in the spring. But that's unlikely to occur today, given the housing situation we're seeing in China as of today.
You mentioned their construction, and this does bring us on to the housing market. If we take a look at this next chart, it shows a variety of markers within the housing industry. Now, looking at specifically at year-on-year growth, it's quite a hectic chart, but I think the most important bit that we can see is sort of the huge rise there, followed by sort of a steep dip, which indicates where the housing market is at present. It doesn't look good, does it?
The housing situation in China actually started in 1998 when the government ended its practice of allocating housing units. And in China, there isn't a lot of choice in terms of investment vehicles. For example, we have a situation where interest rates on deposits are limited or controlled, and they're usually below the inflation rate. We also don't have a really developed stock market. So the only outlet for people to invest their wealth was basically in housing. Now, this was supported by the type of monetary policy that the Chinese government followed from 1998 to basically today. You have to understand is that the yuan was fixed a little bit above 8 yuan to the dollar from 1994 to about 2006. Now, what the government was doing is it was following somewhat of a mercantilist type of policy by keeping its exchange rate cheap. And to keep its exchange rate cheap, it had to purchase dollars and put yuan into the system. That's why the Chinese government is currently holding over $1 trillion of U.S. Treasury bills. But the equivalent of that is the amount of money they put into the system. And also during that time period, by fixing your exchange rate, you imported a large degree of the easy monetary policy that the U.S. was following at the time. So both of these effects had a tendency to increase the money supply in China. Now, the response to the worldwide crash in 2008, what China did was to basically spend a lot of money on infrastructure projects, on public housing, on planting trees. And a lot of that was on borrowed money. And the borrowed money was based on the sale of land, because you're not going to get a lot of revenues from planting trees, okay? So a lot of the financing of this debt was from land sales, okay? Now, what we saw in the case of China is we got to a point last year where the Chinese government was basically losing control of inflation and also was concerned about the housing bubble that was forming. And what they did is they pulled on the brakes. In other words, they raised reserve requirements, they raised interest rates. And what that did is basically created a crash in the housing sector. And that's why we can basically see now that the boom period is over and we're in the bust period. Now, what the Chinese government is trying to do is to actually ease monetary policy. So we're basically seeing a situation where the government is following a somewhat of a stop and go type of monetary policy. They pulled on the brakes last year hard, and now they're trying to ease up the brakes because of the impact it's having on the domestic economy.
You mentioned there the domestic economy, which emphasizes the fact that it's not just the construction trade industry that's impacted by this whole scenario. If we take a look at this next chart, which shows mortgage as a percentage of income in major cities in China, we can see there that sometimes it's 200 to 300%, which is a huge amount, and suggests perhaps just how far this housing market issue can spread across the Chinese economy as a whole.
Well, this number shows that the Chinese government probably waited too late to prick the housing bubble. When we look at the other ratios that we use to examine whether a housing sector is overvalued or undervalued, when we look at price to income or price to rent, we can see that the Chinese market is definitely in a bubble. For example, the UN indicated that the price to income ratio should be between 3 and 6. So in other words, if you have 100,000 of income, then you should be purchasing a house between 300,000 and 600,000. In the case of Spain, it's 1.5 million, and in the case of China, it's 3 million. So it shows you how overvalued the current situation is in China. I know a lot of people are saying, well, China will still have a lot of growth. I just see a lot of clouds on the horizon, okay? And I think one of the 3 lessons we can learn from this is that first is a mercantilist policy doesn't work, just like David Ricardo said way back in the 18th century. The second thing is that you don't avoid a recession by borrowing money, because you just make the situation even worse. And the third thing is that we shouldn't have stop and go monetary policy, where the Chinese tightened monetary policy last year and now is loosening monetary policy. All it does is it creates havoc, because it interferes with money as a measure of value. Something that's very important is that we should fear the boom, not the bust. Okay, we should fear the situation when we have the bubble occurring, because the bust is kind of the necessary adjustment that we need. In other words, the bust is the fact that we need to clear out the bad investments so that we can free up resources so that they're invested in where society has the greatest demand. In other words, the best way to avoid bubbles is not to create them.
Dr. Frank, thank you very much. Dr. Frank Hollenbeck there, telling us how it is once again. He'll be back later this week for another interview. Goodbye for now.